All right, let's dive into the world of finance today. You clearly enjoy this high-stakes investing world, sending over those articles on Ray Dalio and long-term capital management, LTCM. Talk about two sides of the same coin, huh?
Yeah, fascinating, right? Dalio, the founder of Bridgewater, one of the biggest hedge funds.
Mhm.
And then you have LTCM, this fund that seemed invincible, then crashed and burned so badly. Both teach us about how markets work, or, well, how they don't work, maybe.
Exactly. So Dalio first. This guy is a bit of a finance rock star. Everyone's talking about his unique approach and that book of his, Principles. What's his story?
Dalio's story is about building Bridgewater on this foundation of, get this, radical transparency. It's like, imagine a workplace where every idea, every single decision is openly debated, even if it comes from Dalio himself. Data-driven decision-making to the extreme.
Okay, data over gut feeling, I get that. But radical transparency sounds intense, maybe a bit too intense. But hey, it's working for them.
Definitely not your average workplace. But this radical transparency is tied to Dalio's philosophy, learning from mistakes. He had a huge setback in 1982, misread the market, lost big. But he used it as, like, a launching pad. His motto, pain plus reflection, progress. That pretty much sums up his whole approach.
So he turns his mistakes into fuel. I can dig that. But what about these principles? What's the big deal?
Well, one key principle is that data-driven approach. Dalio really believes in studying history, crunching the numbers, understanding cycles to see where the market is going. He even built a model, the economic machine, to help him predict those cycles. And get this, he was one of the few who actually predicted the 2008 financial crisis.
Wait, he saw that coming. Now I need to hear about this economic machine. What's he putting into it that everyone else is missing?
That's the big question, right? Part of it is he's not just looking at economic data. He's factoring in political shifts, cultural trends, even things that seem, completely unrelated to finance, looking for those hidden connections, the signals others might miss.
It's not just about numbers. It's about understanding the bigger picture, the human element behind them. That's fascinating. But hold on, we talked about data over gut feeling. But isn't this radical transparency thing kind of emotional?
That's a good point. It's not about being emotional. It's about removing your own biases, using the collective intelligence of the team. Everyone's challenging assumptions, poking holes in ideas, even Dalio's, getting to the truth.
Interesting. Crowdsourcing critical thinking on a huge scale. Okay, so data, transparency. What else does Dalio do?
Another big one is his long-term vision. He's not interested in those get-rich-quick schemes or chasing trends. He's in it for the long haul, strategies that can take years to play out.
Long-term vision, great in theory, but is it realistic for everyone? I mean, when Dalio was starting out, didn't he go for some quick wins too?
You're right. It's easier to talk about long-term vision when you're already at the top. But Dalio argues, even early on, he was focused on building a system, a way of thinking that would lead to consistent success, not just chasing fleeting profits.
So build the right system, the right mindset, and the results will follow. I like that, but how do we take these principles and actually apply them to our own financial decisions?
That's the interesting part, and that's what we'll be looking at throughout this deep dive. How can you use data to make smarter choices? How can you cultivate that learning mindset? And maybe how much transparency is too much?
Lots to think about.
Yeah.
So we've got Dalio, the data maestro, playing the long game. But then there's LTCM, these math wizards who seemed to crack the code, then went bust spectacularly. What was their story?
Their story is all about what happens when you have these brilliant minds meeting the realities of the market. They were exploiting price discrepancies in the bond market, using complex models and leverage to make big bets.
Price discrepancies. Okay, break that down. What does that even mean?
Imagine two bonds, almost identical, but one is priced a little higher. LTCM would bet that that gap would close, profiting from the correction. They were financial arbitrageurs, finding tiny inefficiencies and exploiting them.
Sounds like they were playing this high-stakes game of whack-a-mole, financially speaking. But it was working, right? They were making a lot of money.
Oh yeah, they were the envy of Wall Street. Returns of over 40% per year, pulling in billions. But their success had a downside. Their models, brilliant as they were, had a fatal flaw.
Okay, so LTCM, this high-stakes game, and it was working. But you said their models had a flaw, a fatal flaw. What was it?
Their models were built on this idea that, at their core, markets are rational. They thought their math could, predict very accurately how prices would move.
Yeah.
But they missed a big thing, the thing that throws all those calculations out: human behavior.
Right. When fear or panic kicks in, logic kind of goes out the window. People aren't that rational when they're worried about losing everything.
Yeah, exactly. And that's where LTCM takes a bad turn. 1998, Russia, having this financial meltdown, defaults on its bonds. You'd think that's unrelated to LTCM, right?
Right.
Wrong. That's where the cracks start to show.
Hold on. How did a Russian debt crisis affect this, this Wall Street hedge fund?
Remember those price discrepancies they were using?
Yeah.
The Russian default, it set off this chain reaction in the bond market, massive volatility. And those tiny price gaps, well, they became huge.
So their models didn't see this coming, this event that messed up their entire strategy.
Exactly. And here's where their other big flaw comes in leverage. They were borrowing a ton of money to amplify their bets. High leverage, high rewards, but also huge losses when things go south.
Like playing roulette with borrowed chips.
A good analogy. And as they lost more, they had to sell assets to cover their positions, stay afloat. But, and here's the thing, they weren't alone. Other investors hit by the Russian crisis, they were also trying to sell a liquidity crunch.
A liquidity crunch. I'm picturing like a cash register, but empty.
Imagine your LTCM needing to sell billions in bonds quickly, but everybody else is selling too. Very few buyers. Not enough cash flowing to handle all the selling.
It's like a fire sale, but the fire's spreading to the whole market and everyone trying to escape.
Exactly. And the more LTCM sold, prices dropped even more. A downward spiral. Systemic risk. One big player failing could bring the whole system down.
This is starting to sound like a financial horror movie. What happened then? Did they go bankrupt?
Almost. It got so bad that the Federal Reserve, they had to step in. They organized a bailout, some major banks involved to get cash back into the market, prevent a total collapse.
Wow, so the government had to save the day and probably save Wall Street from itself. LTCM brought down by, what, a Russian debt crisis, a liquidity crunch, and too much leverage.
A perfect storm. Bad decisions, unexpected events, and too much faith in models. They had the smarts, but lacked one thing, humility.
Humility in the face of the market. I like that.
Yeah.
So we have Dalio adapting, learning from mistakes, and LTCM holding on to their models as the market crashed around them. Two approaches, very different outcomes.
And it's in that contrast that we find the lessons for anyone dealing with finance or any complex system. Because the real question is, how do we balance the data and models with the need to adapt, to use human judgment?
That's a big question, and I guess that's what we'll be looking at in the final part of this deep dive. Okay, so Dalio, the adaptable data king, right? And LTCM, these brilliant minds, but they bet big and went bust. Feels like a big lesson here, but I'm not quite seeing it.
It's about that balance,
Yeah.
relying on data and models, but also being flexible, ready to adapt, because the unexpected always happens, especially in finance.
That's what's so interesting. Dalio, he almost seems to sniff out change before it happens, adapt before the market shifts. But LTCM, they doubled down as things went bad.
That's the difference. Dalio's not blindly following a model. He's testing, refining, always adapting, like a chameleon, changing with the market.
Okay.
LTCM, they were it's like that deer in the headlights, frozen while the truck's coming.
Okay, I get it. Dalio says, the data's saying something new, time to change. LTCM thought they had it all figured out. Missed the warning signs.
Like navigating by the stars versus, just relying on a GPS. The stars can guide you, but you got to read them, change course when a storm comes. The GPS, well, it's great until you hit a detour or lose signal.
Dalio's looking at the whole map, LTCM staring at the screen. But how do we find that balance? Data is important, but we don't want to be slaves to it.
That's the art of it, right?
Yeah.
Models and data, they're tools, guides, not the absolute truth. Know their limits. Just because a model worked before doesn't mean it always will.
So they're like simplified versions of reality. And reality throws curveballs.
Yeah, exactly. And when those curveballs come, that's where judgment, your experience, that's what matters. You got to step back, look at everything and say, okay, the model's saying this, but my gut, my experience says something else. What do I do?
Makes me think about that radical transparency thing again. Maybe that helps, having other smart people, to challenge you, make you see those blind spots.
You got it. Diversity of thought, different perspectives. We all have biases, blind spots. The key is knowing that and being humble enough to say, I might be wrong.
Right, even the smartest can get it wrong. LTCM proved that. And their leverage, that really hurt them in the end, huh?
Leverage, it's like an accelerant. It can boost your gains, but also, send you crashing down. Dalio gets that. He uses leverage, but carefully managing the risk. LTCM, they went all in, and when the tide turned, they were wiped out.
Lesson learned. Don't bet the farm, especially with borrowed money. But what are the big takeaways for someone who's, interested in investing or just trying to make sense of the world?
First, data and models, powerful tools, but just tools. Don't let them run your life.
Got it. Data's good, but don't be a data zombie. What else?
Second, leverage. It's tempting, but dangerous. Handle with care.
Leverage, handle with care. Okay, writing that down. Anything else?
And the most important one, maybe, adaptability. The world changes, markets change. Being able to adjust, to learn, that's how you thrive.
Be like Dalio, the chameleon, not LTCM, stuck in the headlights. Adapt or fade away. I like it. But how do we actually do that? Become more adaptable.
It's a lifelong thing, right? Seeking out new information, challenging yourself, and being around people who are, smarter than you. Embrace the uncertainty. Don't be afraid of it.
It's true. Finance, life, it's all uncertain. It's about how we deal with that, how we learn from mistakes, and adapt to change.
Yeah, well said. And maybe, just maybe, takes a bit of humility, too.
Humility, adaptability, a little bit of skepticism. We've found some real gems today. So as we wrap up this deep dive into Dalio, LTCM, and the world of investing, I'm left thinking, how can you use these insights in your own financial decisions, your own risk tolerance? Because in the end, it's not just about money, it's about how we think, how we learn, and how we deal with this complex, changing world. Thanks for joining us.